Hi students, welcome to the new class. Today we are going to discuss about factors influencing foreign direct investment. Foreign direct investment influenced by several factors in the home country and the host country. Before deciding for the foreign direct investment, several factors should be considered on the basis of analysis of the every factors related with the foreign direct investment. A foreign country decide to foreign direct investment after considering all the factors related with the foreign direct investment. The foreign country or foreign company may decide the way or the mode of entry strategy for foreign direct investment. There are several factors affecting the foreign direct investment. The first factor influencing the foreign direct investment is wage rate. A major incentive for multinationals to invest abroad is to outsource labor intensive production to countries with lower wages. India is a country with a lower wage system. India India have high skilled labor in cheaper rate. If an average base wages in the US are $15 for an hour, but in the case of Indian subcontinent, it is $1 for an hour. Cost can be reduced by outsourcing production. US companies or Western companies comes to India or Indian subcontinent for the purpose of exploiting the difference in wage rate system. However, wage rate alone do not determine FDI. Countries with a high wage rate can still attract high-tech investment. A firm may reluctant to invest in sub-Saharan Africa because low wages are outweighed by other drawbacks, such as lack of infrastructure and transport links. As we considering sub-Saharan Africa, there is lack of infrastructure and transport skills, but there is a low wage system. The major drawbacks of sub-Saharan Africa is lack of infrastructure and transportation. Due to this kind of drawbacks, many firms reluctant to invest in sub-Saharan Africa. Even low wage system is there. Second one, labor skills. Some industries require higher skilled labor. For example, pharmaceutical, electronics, automobile industries need higher skilled labor. Therefore, multinationals will invest in those countries with a combination of low wages but high labor productivity and skills. Foreign direct investment, multinational companies will invest in those countries where low wage system and high labor productivity and skill there. For example, India has attracted significant investment in call centers because a high percentage of population speak English but wages are low. This makes it an attractive place for outsourcing and therefore attract investment. Then third one, tax rates. Large multinationals such as Apple, Google, Microsoft have sought to invest in countries with lower corporation tax rate. The multinational companies consider the corporation tax rate. They prefer lower corporation tax rate. They prefer the countries giving or providing or imposing lower corporation tax rate. For example, Ireland has been successful in attracting investment from Google and Microsoft. In fact, it all controversial because Google has tried to funnel all profit through Ireland despite having operations in all European countries. So, some countries have low corporation tax. It will influence the foreign direct investment. Then fourth one, transport and infrastructure. A key factor in the desirability of the foreign direct investment are the transport cost and levels of infrastructure facility. A country may have lower labor cost, but if there is then high transportation cost to get the goods onto the world market, this is a major drawback for the countries. Fourth one, size of economy or potential for growth. Foreign direct investment is often targeted to selling goods directly to the country involved in attracting the investment. Therefore, the size of the population and scope of economic growth will be important for attracting foreign direct investment. Before investing in a country, foreign companies or foreign country consider the size of the economy or the potential of a growth, scope of economic growth of a country. For example, Eastern European countries with a large population. Example, Poland offers scope for new markets. This may attract foreign car firms like Volkswagen, Fiat to invest and build factories in Poland to sell the goods sell to the population. Then political stability or property rights. Foreign direct investment has an element of risk. Countries with uncertain political situation will be a major disincentive. The political instability of a country will affect the foreign direct investment, and other kind of property right issues also a problem in foreign direct investment that will affect the major factor affecting the foreign direct investment. The seventh one, commodities. One reason for foreign investment is the existence of commodities. On the basis of existence of certain commodities in certain country, that is a major reason for foreign direct investment. For example, in South Africa, some of the countries are investing foreign direct investment made for the purpose of excavating, for the purpose of mining precious metals. Then exchange rate. A weak exchange rate in the host country can attract more foreign direct investment because it will be cheaper for multinational to purchase assets. However, exchange rate volatility could discourage investment. A weak exchange rate in the host country can attract more FDI. Then access to free trade areas. A significant factor for firms investing in Europe is access to European Union single market, which is a free trade area but also have a very low non-tariff barriers because harmonization of rules, regulation and free movement of people. Some of the firms wish to invest in Europe is an access to the European Union single market, is a free trade area but also low non-tariff barriers and harmonization in rules and regulation and free movement of people. On the basis of this, foreign direct investment is promoted this. UK post-Brexit is likely to be less attractive to FBI if it is outside the single market. UK post-Brexit system attractive, less attractive on foreign direct investors. So, if it is outside in the single market. Other factors are customer mobility, avoidance of trade barriers, economic development incentives, marketing advantages, and access to key technology. And what are the motives or objectives of FDI? What are the motives or objectives of foreign direct investment? The major motives are to increase sale and profit, to enter fast growing markets, to reduce the cost of the product, to protect the domestic market, to acquire technology and know-how, exploitation of resources, and diversification of risk. These are the major motives or objectives of FDI. So today we have discussed the factors influencing FDI and objectives of FDI. Thank you.